OG Sean AG here, and today we've got something that changes the entire conversation around what just happened in silver. The Shanghai Futures Exchange didn't hint or suggest anything. They put it in writing. An official notice, numbered 2026 number 37, dated February 5th, confirms that multiple linked groups of accounts were caught blowing past intraday position opening limits in silver contracts. And the exchange didn't respond with a slap on the wrist. They imposed restricted position opening measures across all of them. That is not normal. Exchanges don't do that unless they believe something coordinated is happening, because these platforms are built on confidence. When confidence cracks, everything gets messy fast. Now connect this to the move everyone watched in disbelief. A massive paper dump that totaled roughly 674 million ounces of silver slammed into the market in a single morning session on the Shanghai Futures Exchange. That number isn't just big. It's cartoonishly huge compared to real-world metal flows. A hit like that doesn't come from ordinary hedging. It doesn't come from a few nervous traders. It comes from deliberate, aggressive positioning meant to smash price and force liquidation. And now we have the exchange effectively saying, we saw it. We traced it. We're restricting the accounts. You can call it whatever you want, abnormal behavior, manipulation, coordinated short attack. But the point is the same. It wasn't random. As I'm recording this, here's the price situation that makes the paper versus physical split impossible to ignore. Western spot is around $74. Shanghai spot is roughly $82. Shanghai futures are about $99. And the Shanghai premium is around $8. When the pricing structure starts looking like that, when one side of the world is showing a different reality than the other, it's a signal that something deeper is happening than the average risk-off day explanation. That's not just volatility. That's the market flashing a warning light. Quick note for anyone new here, because this is important and it keeps you safe. This channel will never ask you for money, never pitch paid signals, and never run investment funds. If someone is doing that in my name, it's a scam, period. This channel is built on verifiable data and straight analysis, not recycled hype with a fake urgency timer slapped on top. If you're looking for someone to tell you silver is going to $1 million tomorrow, or that it's going to zero by next week, you'll find plenty of copycats who can sell you that fantasy. They'll spin every data point into whatever story performs best that day. Green candle, moon confirmed. Red candle, collapse confirmed. I'm not here to perform. I'm here to explain what the numbers are telling us, even when it makes everyone uncomfortable. Back to the timeline, because this is where it starts to get serious. The narrative that's forming is not silver randomly dumped. The narrative is that a very large net short position had been built, and then the market was hit with an extreme paper sell program. People are discussing a major player, often described as billionaire widening, associated with building one of the largest net short positions in silver. Whether you focus on the name or not, the key point is scale and intent. A hit of 674 million ounces in one session screams intent. It screams coordination. And the exchange responded immediately by restricting 6 groups of linked accounts, citing abnormal trading behavior. The words may be polite, but the implication is not. While that's happening in Shanghai, look at what's happening on the COMEX side, because this is where paper and physical start fighting like two different markets. On COMEX, you had millions of ounces of physical pulled from vaults in a single day, around 3 million ounces reported out. You had an unusually high percentage of contracts settling physically instead of rolling or cash settling, with claims of near 100% physical settlement compared to normal behavior that tends to sit far lower. You had total inventory around the 400 million ounce range. And you had the bigger problem, open interest exposure towering over registered metal. This is the part most people skip because it's not a meme, but it's the foundation of the entire stress test. If open interest represents hundreds of millions of ounces and registered stock is a fraction of that, the system works only if most participants don't demand delivery. It's a confidence structure. It functions as long as the crowd behaves a certain way. But the moment delivery demand rises, the math stops being a spreadsheet exercise and becomes a logistics and credibility problem. That's the shift we are watching. Now layer in what the CME is doing, because the CME doesn't move margins for entertainment. They've hiked margins again. Third increase within about 10 days. with changes going into effect after the close on Friday, February 6th, 2026. Maintenance margins up roughly 11% for gold futures and roughly 20% for silver futures. And here's what should make you pause. This is happening even as prices have been falling. People who don't understand market plumbing think margin hikes only happen when markets are euphoric and running hot. That's not true. Exchanges hike margins when volatility is high and when they're worried about default chains. They hike margins when they're protecting themselves. And silver is getting hit harder than gold. That matters. If gold were the bigger risk, gold would be punished more aggressively. Instead, silver's margin requirements get pushed higher because silver's price action and positioning risk are more dangerous to the system right now. High margins are not a vote of confidence. High margins are a stress indicator. They're basically the exchange saying, we want less leverage here because if this goes wrong, we don't want to be holding the bag. People will say, but volatility is high. Margins should rise. Sure, and volatility is high. Silver's average true range has been cited around a record $14.17 per ounce, roughly 19.3%. If daily movement is that extreme, then higher margins can be justified as aligning collateral with risk. But again, context matters. Exchanges don't raise margins out of comfort. They raise them out of fear. They raise them because they see a crowded trade and they see the possibility that one side can't pay if things snap the other way. You can raise margins on paper. You can't margin call physical scarcity. You can't print delivery bars because the chart got ugly. If physical supply is tight while paper supply is unlimited, the only lever the system can pull is leverage itself. That's what margins are, a lever. Now look at what happened to futures open interest after the forced crash. A drop of about 6,000 contracts on COMEX is being discussed, with the idea that a chunk of that might be tied to tokenized silver products around the March 26th contract cycle. Total open interest was mentioned around the 137,700 range. Regardless of the exact attribution, the bigger point is the behavior of the long side. If longs were purely speculative tourists, they would disappear when the market gets violent. Instead, the data being cited suggests many are sticking around, waiting for delivery, not flipping for quick profit. That's why this isn't just a price story. It's a settlement story. And this is where the numbers start to feel absurd. There are references to open interest exposure equivalent to roughly 688.5 million ounces against registered silver around 103.3 million ounces. Even if you debate the precision, the imbalance concept is what matters. Claims on silver are far larger than immediately deliverable registered inventory. The system survives if most people play the paper game and don't ask for the metal. But if the culture shifts, if participants start treating futures like a pipeline to physical, then the system is forced to choose between three bad options. Find metal quickly, allow price to rise to a level that reduces demand and encourages supply to appear, or declare some form of force majeure/cash settlement structure that shatters confidence. Those are the realistic paths when the math tightens. Shanghai adds another layer. There are reports of a sudden drain in SHF-related vault stocks, leaving around 350 metric tons, roughly 11.2 million ounces, after a sharp one-day reduction on the order of 15%. Whether you focus on the exact day-to-day prints or the trend, the message is the same. Physical is leaving. And here's the part that should be obvious, but somehow still shocks people. Artificially low prices are a problem for exchanges when physical demand is strong, because low prices accelerate withdrawals. If buyers see bargain prices and the metal is available, they'll take it. That drains the system faster. Suppression doesn't solve scarcity. It can intensify it by encouraging real demand. Now let's talk about the March delivery crunch, because this is where the pressure becomes a calendar event, not just a theory. COMEX delivery data being discussed suggests that 2025 saw total silver deliveries around 474.4 million ounces, more than double the 202.7 million in 2024. That is not noise. That is a behavioral shift. Month after month, deliveries were reportedly higher year over year, suggesting participants are increasingly choosing physical settlement over rolling paper. That's what you do when you don't trust future availability at current prices, or when you don't trust the paper system to remain stable under stress. January 2026, normally a quieter month, was described as exploding to around 49.4 million ounces delivered, far above what many would expect for a slow period. That looks like front-running. That looks like people saying, I don't want to be last in line. And then February 2026 reportedly started with nearly 19 million ounces delivered in the first few days, almost matching all of the previous February's total. Even more telling is the claim that nearly all open interest stood for delivery in that early window, far beyond what typical delivery behavior looks like in a normal futures culture. This is the point where the futures market starts behaving like a physical market, and that's when paper stress becomes existential. If March open interest represents the equivalent of roughly 429 million ounces, then delivery percentages become the whole story. At a 25% delivery rate, you're looking at over 100 million ounces demanded. At 50%, you're talking about over 200 million. At 70%, you're approaching 300 million. Compare that with registered metal around 103 million and potentially trending lower if daily drains continue. If registered stock were to fall towards something like 85 million by the start of March, as some calculations suggest under ongoing withdrawal rates, then even a repeat of a previously stressed March could become harder to manage. Yes, there is eligible silver, but eligible doesn't mean available. Eligible metal belongs to someone. It becomes registered when the owner decides to make it available for delivery. And why would owners volunteer metal into the delivery pool at prices they consider artificially suppressed, especially if they believe the system is tightening? If you think price is going higher or availability is going lower, you hold. You don't donate inventory into a strained system just to help it survive. That's why the eligible exists argument is often a comfort story rather than a solution. The owners decide, not the chart. So the tension builds. Even if March matches last year's stressed delivery numbers, that still leaves the system thin for the next active months. If withdrawals continue and demand remains elevated, May, July, and September become additional pressure points. This is how confidence breaks, not in one cinematic explosion, but through repeated moments where the system has to make exceptions to keep the game running. Cash settlements, special incentives, rule changes, temporary measures. The more that happens, the more participants learn that paper price is not the same as physical reality. Now zoom out, because there's a separate force smashing everything at once: systemic deleveraging. There's a narrative that the crypto sell-off triggered broader liquidation pressure, including forced selling tied to tokenized silver products, which then fed into futures, ETFs, and swaps. There are claims of enormous crypto market cap drawdowns, hundreds of billions wiped in short windows, and combined declines across crypto and metals measured in trillions at intraday lows. Whether you use those exact figures or not, the phenomenon is real. When leverage unwinds, correlations go to 1. Everything sells together. That doesn't mean every asset became fundamentally worse at the same moment. It means people are getting margin called, risk managers are cutting, and liquidity becomes the only priority. Add equities into the mix. There are reports of major single name drops. Amazon cited as falling sharply after Q4 2025 earnings, contributing to a broader risk-off mood. There's also talk about institutional flows, with hedge funds reportedly unloading U.S. stocks at the fastest pace since October on certain days, with multiple sectors experiencing liquidation and pressure concentrated in tech, industrials, and materials. When big money is de-risking, it hits everything with a bid/ask, including metals, especially paper metals that are easy to dump quickly. This is where people get trapped psychologically. They see silver dumping and assume it's bearish. But look at the physical side. Price down, inventory down. That is not what a normal bearish commodity setup looks like. In a truly bearish environment, demand collapses and inventory rises because nobody wants the product. Here, you have the opposite. During sell-offs, physical is leaving vaults. That tells you the sell-off is financial, not fundamental. Paper is pushing price down. Physical buyers are using that discount to drain available stock. Paper can create supply infinitely. Physical removes supply permanently. And you're seeing it globally. There are reports of retail demand surging even on weakness. Stories of people queuing for gold in Singapore at United Overseas Bank, the only bank there offering physical gold, even as prices fell. Similar anecdotes are mentioned across Australia, Thailand, and China. That's not what demand destruction looks like. That's what buying the dip in real metal looks like. Even the paper ETF world is flashing panic volume. SLV trading volume being cited around record levels. Numbers so large they're described as exceeding any single stock's volume globally on the day. When you see volume spikes like that, it usually means violent repositioning, forced liquidations, capitulation, and big hands moving size quickly. It can mark a turning point, or it can mark the middle of chaos. Either way, it's not calm participation. It's stress. Technically, the sentiment contrast is also striking. Last time silver was around the mid-$60s, it was framed as euphoria with a high RSI reading. Now you can be at a similar price level with RSI much lower and fear everywhere. Same price, different psychology. That doesn't automatically mean the bottom is in. It means sentiment can swing wildly without price needing to move much. And that's usually what happens when leverage gets unwound and narratives flip. Here are the risks, and I'm not going to sugarcoat them. Margin hikes force more liquidation. That's their job. If you're over-leveraged, you will be pushed out, and the market will not care about your thesis. Bitcoin and crypto pressure can keep the whole system in risk-off mode longer than you expect. Geopolitical tension headlines can accelerate the sell everything trade. When everything dumps together, it's not a normal market. It's a deleveraging event. In those environments, price can overshoot violently because the selling isn't discretionary, it's forced. But now here's the structural tension that doesn't go away just because the candles are red. Shanghai's exchange has effectively documented abnormal, coordinated behavior and restricted multiple linked account groups. COMEX registered inventory is being discussed around roughly 103 million ounces, while exposure is far larger. March delivery is approaching fast. Shanghai vault stocks are reportedly draining sharply. Physical settlement rates are being discussed at extreme levels compared to historical norms. Physical demand anecdotes are showing up across regions. Paper volume is exploding, and price is being shoved lower in the middle of physical tightening. That is not a stable combination. So what does it mean? It means paper and physical are at war, and the battlefield is the delivery calendar. If the paper side can force enough liquidation through margin hikes, volatility, and cross-asset risk-off pressure, they can reduce demand for delivery and buy time. If the physical side keeps pulling metal and more participants stand for delivery, the system gets squeezed where it's weakest: availability and confidence. That's why the exchange actions matter so much. Exchanges are supposed to be neutral marketplaces. When they start restricting linked accounts for abnormal behavior, they're telling you they see destabilizing activity, and they're trying to keep the engine from seizing. In my view, there are only a few realistic outcomes from here. Either the system finds a meaningful amount of metal quickly, which is harder than it sounds when everyone is watching, or price is allowed to rise enough to cool demand and coax supply forward, or the rules shift in a way that reveals the paper contract is not what people thought it was. None of those outcomes is business as usual. And that brings us to the question everyone really wants answered. Is this the low, or is there more pain first? The honest answer is that both forces are real at the same time. The structural shortage signals are real, and the risk-off deleveraging is real. The market can keep hurting people longer than they think, especially when leverage is involved. But the math of physical availability doesn't care about your timeline either. If delivery demand is large enough, it doesn't matter how many paper ounces get dumped. The system eventually has to reconcile claims with metal. So don't let anyone hypnotize you with certainty. Certainty is how people get wrecked. Watch the data. Watch delivery behavior. Watch registered and eligible trends. Watch exchange rule changes. Watch margin adjustments. Watch whether Shanghai premiums persist or widen. Watch whether physical continues draining during sell-offs. That's the real scoreboard. And for anyone trying to turn this into a cartoon story, here's the simple truth. A market can be smashed on paper in minutes, but physical reality moves slower and hits harder when it arrives. If paper is pushing price down while real metal is being removed from the system, that's not a bearish signal. That's a warning that the pricing mechanism is under stress. If you're a short-term trader, your job is to manage risk and survive volatility. If you're watching this from the perspective of physical supply, your job is to focus on inventory and settlement behavior, not just candles. Do your own due diligence. Understand that margin hikes can cause more liquidation before anything resolves. Understand that cross-asset risk-off can keep pressure on everything at once. But also understand that Shanghai's exchange just confirmed something the market suspected in an official notice, and physical flows are not behaving like a healthy, balanced market. The next few weeks into March are a live stress test. Which force wins first, forced deleveraging or physical scarcity, will shape what comes next.